Hey folks, it's Simon here with your Tao Daily video for Monday the 5th of August 2024. There's a lot to talk about today, so we may go a little bit longer than the normal 3 minutes. Now, obviously we're in the midst of a fairly major sell-off. We had, this is just going back to Wednesday, we had a little pop post the FOMC. That was mostly reversed on Thursday, and then Friday we had some pretty crappy market action, and the NASDAQ futures currently down another 3%, although trading well off their lows. You can see how they came in, checked with their 200-day moving average, and we're getting a little bounce here. Now, do we buy this bounce? I'm going to say you've got to really know what you're doing. You've got to be nimble. You've got to have a higher risk tolerance for buying dips in equities in this environment. Okay, we're not in a buy the dip environment, like I said, unless you're very nimble and you know what you're doing. Okay, we're more in a sell the rallies kind of environment now. So let's talk a little bit about what's going on. Now, people will blame the jobs number. Really and truly, this all started with dollar yen. All right, if we go back and have a look at USDJPY, it is no coincidence that dollar yen peaked on the 10th of July. And if we look at the NASDAQ, that also peaked on the 10th of July, both of those on a closing basis. All right, so Japan has had zero or negative interest rates for the past 3 decades, which has seen a massive yen carry trade build up. And with the massive strength we've seen in the yen, remember weakness in USDJPY and dollar yen is yen strength. So massive yen strength has seen a massive unwind in the yen carry trade. Remember, if you're borrowing in yen at zero interest rates and yen strengthens significantly, you might be laughing because your cost of finance is very cheap in interest rate terms, but your debt has just got a whole lot bigger. Oh, and by the way, the BOJ put up interest rates last week and they've left the door open for further hikes. All right, so we're seeing the unwind of yen shorts. We're seeing unwind of this yen carry trade. We're also seeing the unwind of 2 other very, very crowded trades. One is long stocks. How do we know people were long stocks? Well, we can look at things like non-dealer positioning in US equity index futures. They're at all-time highs. We can look at things like CTAs. Very, very asymmetric profile here, buying versus selling. Okay, you're going to be sellers even in a flat tape. The other trade that was very crowded is short volatility trades. We have seen billions of dollars go into strategies that rely on short volatility strategies in the past couple of years, and we are seeing signs of them getting unwound. All right, Friday, 2nd of August, was the highest transaction volume of options ever traded. All right, so this is a sign that short vol trades are getting unwound, but there's potentially a lot more to be done there. But this simultaneous de-risking of long stocks, particularly long AI and Mag 7, short yen and short vol, it's all happening at the same time, is creating a very sort of untidy exit. And for as long as vol remains elevated, systematic traders will be really putting their holding their foot against the throat of the equity market. All right, systematic traders are also very long equities going into this, and they are forced to sell in volatile time when volatility rises. And like I said, they're going to keep hitting the bid in equities until volatility subsides. And the other thing that we should talk about is the economic data. Okay, the jobs market it's no longer tight. All right, it's not weak, it's just not as strong. It's no longer tight, it's sort of a lot looser. But what we're looking at though is a year-on-year decline, a deterioration in most of the key sort of economic data that we would track leading into recession. Things like, let me just bring the chart up. Chicago PMI, ISM manufacturing, ISM services, they're all in contraction territory. Durable goods is down 10% year on year. Unemployment, now this was as at June, okay? This doesn't account for the figures that were released on Friday, but jobless claims, unemployment rate, all moving in the wrong direction, as are non-farm payrolls now. Housing, all of the key housing stats year on year in decline. They got a bit less bad in June, but whether June is just a blip remains to be seen. And consumer confidence is at the lowest point in over a year as well. We're also seeing the yield curve normalize after the longest ever period of inversion. The unemployment rate is up 0.8% within 12 months. 100% of the time that has happened in the past. It has preceded a recession. The SARM rule has also triggered. All of the classic recession signals are lining up. And this is why, within a week, the market has gone from treating bad news as good news to bad news as bad news. Right? The more common pattern for the equity market has been to rally on bad news because of the promise of rate cuts bad economic news brings. What happened on Thursday and in more dramatic fashion on Friday is the market sold off on bad news. All right, so we're in the midst of a growth scare. Will this growth scare metamorphosize into a recession? I'd say the odds favour that at this point. So what to do? Well, if we have a look at equity index, now let's look at the futures just to get a kind of more up-to-date idea of what's happening. So we'll look at NASDAQ futures. So they are already quote-unquote oversold. All right, so we could expect a bounce from these levels, and we could get a fairly sizable bounce. But what will typically happen after a surge in the VIX like we've seen is, you'll get a massive rally one day that feels great. Oh, thank goodness the selling is over, followed by a gut-wrenching decline the following day. All right, people are going to get whipsawed in this market. If you get sucked into chasing moves, you're going to get whipsawed. Now we've seen a big spike in vol. VIX at 30 is highest it's been in well over a year. Now big spikes in the VIX typically roughly coincide with a market low, a short-term market low, but they don't usually exactly coincide with it. All right, so we could get a low today, or it may come this week. But like I said, expect a lot of choppiness because these trades, the crowded trades that I just talked about, given their size, they're not going to get unwound in a week. Right, it's going to take time for this positioning to unwind. The other thing to show you is the VVIX. This is the volatility on volatility. This has skyrocketed to levels approaching what we saw in March 2020 during the COVID crash. All right, so and typically spikes in the VVIX, they're not one-day affairs. Often they'll cluster. You might say 3 to 5 days with a very high VVIX. So, I'm not expecting volatility to normalize and drop like a stone tomorrow. I think it could take longer than that. So yeah, we may get a mammoth bounce in stocks today or tomorrow, but it doesn't necessarily mean the market low is in. Showed you a chart of non-dealer positioning in US equity index futures. It was basically at all-time highs. The put-call ratio too tells us that everybody is long. This has got a long way to go before normalizing. All right, so again, the amount of length that's been built into markets is going to take a while to normalize. So don't catch a falling knife. Don't try and buy the dip unless you've really got a trading plan and you know how to manage your risk. Where we are in a more of a buy the dip environment is in bonds. If we just have a look at 10-year bond futures, here I think we can buy the dip, but don't panic by Monday morning. All right, these are very stretched to the upside. So I would be looking for a reversion to the mean and then look to reload there. I wouldn't be chasing bonds higher out of some sort of panic. Now, yeah, things that are stretched to the upside can get more stretched. Things that are stretched to the downside can also get more stretched to the downside. But I think if you're looking for something to do on Monday, it's too late to short stocks. I'd be very cautious about buying the dip, as I've said, and I'd be very cautious about chasing bonds here, but I think they are viable on a pullback. I'm flat at the moment. My trading book is 100% cash, and my game plan here is just to watch and wait for high probability opportunities and to, above all, not get suckered into chasing moves. That's what I got for you today. I hope it helps, and I'll catch you tomorrow. Thank you.